Welcome to The Explainer. Today, we are digging deep into a real powerhouse, Accenture. They're one of those blue-chip giants that pretty much helps run the world's biggest companies. But after an absolutely stunning run, its growth has just hit a brick wall. So for investors, the question is really pretty simple.
Right, so let's get into it. We're looking at a true titan of industry, but it's facing this really dramatic slowdown. And that creates a critical decision point for anyone watching the stock. Is this just a temporary dip that savvy investors should be buying into, or is it a major warning sign of some deeper problems ahead?
To really get what's at stake here, we first have to wrap our heads around just how sharp and sudden this shift has been. It's what has put Accenture at this really pivotal moment.
The sheer speed of this slowdown is kind of staggering. Just think about it. Going from nearly 22% growth, that's full-on post-pandemic boom territory, all the way down to just over 1% only 2 years later, that is a massive, massive deceleration. And as you can probably guess, that kind of U-turn has totally spooked the market and sent the stock tumbling way off its highs.
So, before we dive into the whole bull versus bear debate, let's take a quick second to break down the foundation of Accenture's power. To understand where it might go, you gotta understand why it became this nearly $250 billion titan in the first place.
For any investor, one of the most important ideas is this concept of an economic moat. Basically, it's defense against the competition. And, by almost any measure, Accenture's is considered just exceptionally wide. It's really built on two incredibly powerful pillars.
So Accenture's moat, it really rests on these two things. First up, its brand. When a Fortune 500 company is about to bet billions of dollars on a huge transformation, who do they call? They hire the trusted name. And second, and this is so key, are the high switching costs. Accenture services literally become the central nervous system of their clients' operations, which makes it incredibly difficult and expensive to just rip them out and start over with someone else.
And that powerful moat protects an incredibly diversified business. This chart right here shows you they are not dependent on any single industry. That balance is a huge advantage. When, say, tech spending slows down, strength in public service or resources can step in and help cushion the blow.
All right, let's switch gears and look at the optimistic view. What's the argument that this recent slowdown is just a temporary blip on the radar before that massive growth engine kicks back into high gear? Okay, so the bull case basically argues that the runway for growth is still gigantic. Accenture operates in this massive, growing, trillion-dollar market. And now, the rise of generative AI is creating what could be a once-in-a-generation wave of new demand. On top of all that, the company is not just sitting on its hands, it's being super aggressive, acquiring the skills and companies it needs to capture all that future growth. And this is the crucial point here. While that headline revenue growth looks slow, management saw an opportunity. They more than doubled their spending on acquisitions. They used their financial strength to go on a shopping spree for companies that specialize in AI, cloud, and all these other high-growth areas, probably while their competitors were pulling back. They're essentially buying their future growth right now.
But of course, there's always another side to the story. There are some very real risks on the horizon, so let's take a look at the big challenges that have investors so worried.
This chart just lays out the core of the bear case in really stark visual terms. The drop has been so rapid and so severe. And this isn't some theoretical thing. It reflects real-world clients tightening their belts, delaying big projects, and just getting way more cautious in a pretty uncertain global economy.
And here it is, maybe the biggest long-term risk for investors, the great paradox of AI. Right now, it's a massive opportunity. It's driving huge demand for consulting. But what about 10 years from now? That very same AI could end up automating the core work that Accenture gets paid billions to do today, which could potentially cannibalize its own business. It's a real double-edged sword.
So how in the world does an investor weigh these two powerful competing arguments? Well, let's turn to the data and look at the key metrics you really need to be watching to see which way the story is actually heading.
Because of this whole slowdown, the stock has gotten a lot cheaper. Its price-to-earnings ratio, which is basically the price you pay for $1 of the company's profits, has fallen to around 19. Now, that's well below its 10-year average of 26. What that tells you is that market expectations are now super low. The market is pricing in a future of really sluggish growth. For a bull, of course, that could be a major opportunity.
Now, this is arguably the single most important number for any investor to be watching right now, the book-to-bill ratio. Why? Because it's the single best leading indicator for where the business is headed next.
So what does a 1.25 actually mean? Well, think of it this way.
For every single dollar of revenue that Accenture recognized last year, it signed $1.25 in new contracts. New business is flowing in the door 25% faster than the current business is being completed and billed for. That's a powerful, forward-looking signal that growth could be about to pick back up again.
And that brings us to the final and most critical question. Accenture's entire business model is built on helping other companies navigate massive technological change. But now it faces its own existential reinvention in the age of AI. For an investor, the bet really comes down to this. Can this titan successfully navigate the very same disruption it's selling to everyone else?